Hello investors, welcome back to our channel. Today I got something really exciting to share with you. We're diving into the world of the financial derivatives and exploring the incredible benefits that they may come to us. So let's get started. Today we want to introduce you the interest rate swap. So interest rate swap is one of the most commonly used derivatives among all the markets. So I know that derivatives may be a little bit intimidating to all of you, but trust me, after we have broken it down, you will see how much powerful it is and how much revenue you can get it. Okay, so what is an interest rate swap? Interest rate swap is a contract agreement where any one party exchanges further interest payment with another one. So they're using a specific principal account and on an agreement basis, or after a period of time, they can exchange their payment. So either this interest rate can be fixed or variable. So this trade can be happen over the counter where are tailored between two or more even parties. Specific requirements allowing for extensive customer options. So the interest rate swap can be arranged with bank or other financial institutions, and fees will be payable to them. So a bank may be better equipped to find a counterparty, especially in multiple markets for swap transactions. A normal company may be difficult to find a counterparty one. So what are the major types of interest rate swaps? The first one is a fixed to variable interest rate swap, which means that one party they are paying a fixed amount of interest rate, another one they are agreed to pay with a variable one. The next one is the vice versa, which means a variable interest rate swap to a fixed one. Also, the two variable interest rate swap can be equipped while they have negotiated terms which can be different from two parties, and later they can exchange their payment. So these three are the major types of interest rate swaps. So what is the major procedures of interest rate swaps? First of all, you need to create a principal account. Also, you have to define the rates that two counterparties have to do. That whether it's a fixed or a variable one. So after that, they go to the bank and have the contract prepared for the interest rate swap. And after the period of time, they're going to pay it within the bank. So this is the major steps on how interest rate swaps are performed. So why should we consider interest rate swaps? Well, they have some fantastic benefits that I'm going to introduce to you. First, interest rate swap is a really good tool for risk management. Interest rate swaps help you manage the risk of interest rate fluctuations by locking in fixed rates or converting floating rates to fixed rate. So you no longer have to deal with the sleepless nights worrying about the interest rate, whether it's hiking after the Fed miss, or even get a downturn afterwards. The another one is cost reduction. So by choosing the right swap, you can reduce borrowing costs or increase your investment returns. It's like finding the perfect bargain during a big sale. So only at this time, you have to maximize the financial gains with this cost reduction. Also, the flexibility that interest rate swaps brought are incredible. You can customize the swaps to meet your specific needs, whether you're hedging, speculating, or simply looking to generate cash flows. It's like having a financial toolkit ready to tackle any situation that you are coming to fight. So the last one is speculations. Your attention or investors and risk takers that interest rate swap can be a fantastic tool. You can leverage anticipated change in interest rates or their relationship to potentially score big wins in the market. So interest rate swaps for speculations come with risk also. So this have to do your homework. Okay, so what are the major participants in the Asian swap markets? Of course, the big banks. Major banks like HSBC and Deutsche Bank, they are going to provide the swap service for their clients. The next parties are the clearing houses, such as HKEX. They are also major participants in the Asian swap markets. So the last but not least is the regulators. They are going to monitor the entire derivatives events in the Asian market. So there are also some kinds of components that we need to consider while we're trading an interest rate swap. Of course, what kind of interest rate we are using? Majorly in Hong Kong, we're using HIBOR, Hong Kong Interchange Bank Overnight Rate, and also SOFR, the Secured Overnight Bank Rate. These are the most commonly used interest rate swap in the Asian market. So also we need to consider some of the policies of some kind of, that are made by the government, such as the monetary policy that may be influenced a lot with the interest rate. So government and also the rate itself is also very crucial to the interest rate swap market. Okay, so let me show you an example of a typical interest rate swap. So an example of interest rate swap between a bank, let's say this is a party A, and a company, let's say it's called party B. They agree that a fixed and variant interest rate swap, which means that the bank is paying a fixed amount on the interest rate, and the company is paying a variant interest rate. The amount is due on $5 million US dollars, which means that after the interest rate swap terminates, they have to pay this amount. So at the first, as the trade date, which means today, the bank is paying a 4.95 US dollar interest rate with the 5 million to the company. After a year, the company has to pay the bank back with a SOFR interest rate, which means a variant interest rate depends on the interest rate 1 year later. The amount of say is $5 million. In this way, if the interest rate is higher than 4.65, then the bank can receive a more and a greater amount of money. Likewise, the company that are doing the interest rate swap with the banks, they're going to lose the money. So, as easy as I mentioned, this really depends on the interest rate 1 year later, which is the SOFR, to determine the revenue of these two companies. So, what kind of risk we are facing while we are trading interest rate swaps? The first one not to mention is the interest rate risk. The Fed has hiked the interest rate for more than 500 basis points throughout the last half year. During this such fluctuated market, trading interest rate swap may easily cause huge loss. So we need to monitor the interest rate all of the time while you're doing interest rate swaps. So, and also counterparty risk and also liquidity risk are the major risk that brought while you are trading interest rate swap, because this is a contract that have to do after a year, not a continuous payment. A huge amount of transaction may cause liquidity issue to the counterparties. So choosing the right counterparties or agencies such as the banks is also a risk to concern while trading an interest rate swap. So at the end of the day, why we recommend interest rate swaps to you guys throughout this time? As we have mentioned before, the interest rate is so fluctuated within this year, and although the Fed is trying to pause the increasing of the interest rate, we're determining that the interest rate will still be very fluctuated throughout this year. So this is maybe once a 5 year to 10 year chance for you guys on your own determination how the interest rate will go, and you can get a huge amount of income doing interest rate swaps. During the low interest rate era, the return may not be that significant compared to these days. So risk brings rewards. We do recommend you to embrace all the events that are happening this year, and maybe a very good chance while minimizing the risk that you may have to face, and you can get the rewards. Okay, this is our recommendation. Thank you. Hi there, financial enthusiasts. Welcome back to us.
Stop.
Yeah, so what is an interest rate swap? You just sold 95% of US dollars.
I am not done.